So after over 2 years of me helping you to save tax on Instagram, I thought it's about time I started this YouTube channel. This channel will be all about how you can pay less tax in the UK. Today, I'm going to be breaking down everything you actually need to know before deciding whether to go limited or to stay as a sole trader, and how to save as much tax as legally possible once you do. So here's what we're covering. We have the pros and cons of operating as a sole trader or limited company, my recommendation on whether you should go limited based on your income levels, the main tax saving strategies for you that you can utilize, the top tax planning tools to extract money with little or no tax that most people miss, what you should and shouldn't expect from your accountant, and finally, a quick overview of VAT and holding companies as your business grows. I'll keep it short and sharp, but by the end of this video, you will know exactly which route to take and how to keep more of your income in your pocket. So, should you go limited or stay as a sole trader? One of the most commons I get asked from new business owners is, should I register as a limited company or not? And honestly, there are benefits to both. The benefits of a limited company, you have more flexibility around how and when you pay your tax, which can help you to limit your tax bill. You get access to more tax reliefs, and it's less risky because a company is deemed as a separate legal entity to yourself. I'll come on to the tax benefits shortly, but first I want to explain why a limited company reduces risk. So if you're operating as a sole trader and God forbid something went wrong in your business, let's say you got sued or you ran out of money and you owed a supplier a lot of money for a big invoice. As a sole trader, this liability would fall on you, which would mean that your personal assets like your house, your car, your personal savings could be at risk. All the assets that you owe could be taken from you in order to settle whatever it is that needed settling. However, with a limited company, that risk is reduced because you and your company are not legally the same thing. Meaning, if your company was sued for the same thing or you couldn't pay a large invoice, your personal assets, your house, your car, your savings, they wouldn't be liable. No one will be able to come after those assets for you because you, the individual, are deemed separate from the limited company. So that is why it reduces risks. Now, of course, there are some drawbacks of a limited company. You know, there's slightly more admin. There's going to be slightly higher accounting fees because there's more admin. But the admin difference now is nowhere near as bad as it used to be, especially with the new Making Tax Digital rules for income tax. That's because from April 2026, if you are a sole trader, you'll need to file quarterly submissions for your account if your income exceeds £50,000, and the year after is going to be if your income exceeds £30,000. So whilst there used to be a big difference in the admin tasks, that has now been reduced significantly now because there's also a lot of admin assigned to being a sole trader. So I think more and more limited companies are becoming a more attractive option. So my recommendation based on income, I mean, every business is of course different, but here's my general rule of thumb. If your income is over £50,000, that is combined between property and business, I would definitely recommend going limited. If your income is between £30,000 and £50,000, I would say it's kind of 50-50. It's not going to make much difference either way if you're limited or sole trader. If your income is under £30,000, I think a sole trader is perfectly fine. Why these numbers? Because you only start to see meaningful tax savings once you pass about 50k of profit. By meaningful tax savings, I'm essentially referring to the fact that where your tax savings will outweigh the increased accounting fees. So incorporating should at least then pay for itself. Also, beyond 50k, the admin difference between being a sole trader and limited company is tiny, thanks to those Making Tax Digital rules that I touched on earlier. Now, risk-wise, this is where it's up to you to decide on your risk appetite. It depends on how comfortable you feel operating as a sole trader, knowing that if you were ever sued, if you ever couldn't pay an invoice, your personal assets would potentially be liable to be taken from you. But from an income level, 50k and above, I would definitely register. 50-50, kind of up for you to decide on that one. And if you're below 30k, then I would say it's not really worth it from a tax saving benefit, but you may still want to do it from a risk perspective. So what tax reliefs are available to you and how should you pay yourself? If you decide to go limited, it's important you understand all the tax reliefs available so HMRC don't take any more money than they need to. One of the biggest advantages of the limited company is that you don't have to draw your profits out the company each year. You can take what you need now and leave the rest in your company to help you to avoid higher personal tax rates. If you're a sole trader and you earn money in a particular year, you have to declare it in that year. That is one of the differences between a limited company and a sole trader. Now, most people know the basics. When you pay yourself through a limited company, you're going to want to do a salary and dividend split. You'll pay yourself a small salary of £12,570. You can do that however you want, but typically you do just over £1,000 per month. And any extra income you want to take, you will really want to declare that as a dividend. Now, most clients that I work with want to keep their declared income under one of these thresholds. You have the £50,000 threshold because this is when the dividend tax jumps from 8.75% to 33.75%. You have the 60k threshold because above 60k, you start to lose access to your child benefit. And there's the 100k threshold because this is where there's a higher rate of tax, again known as the tax trap, where essentially your effective tax rate can be more than 60% if you start to lose your personal allowance. That means that for a lot of my clients, any extra cash they generate above these values, they typically want to leave in their company so they don't get pushed into the higher thresholds for their personal taxes. Now, let's do some more advanced tax planning for limited companies. Once you've taken your desired income, we look at additional strategies we can use to pull more money out of your business with little or no tax. Some of the main ones include contributing to a director's pension, investing into an ISA, purchasing tax efficient assets like electric cars, using gift vouchers to pay yourself under the trivial benefits allowance, maximizing your tax-free savings allowance, and on top of this, your accountant should be looking to recharge legitimate personal expenses that you've incurred back to your business wherever it's appropriate. Now, this might include mileage for business journeys in your personal car. It might be a portion of your household bills if you work from home. Think about utilities, broadband, workspace costs, and so on. Your mobile phone can be recharged back, repairs related to your home office, and loads more. These small wins that I've just mentioned add up, especially when you're planning properly and adding it all together. So what should your accountant be doing for you and what should you expect from them? When you're picking an accountant, my first tip is to make sure they're also a tax advisor and not just someone filling in the forms. The bare minimum I would expect would be a tax planning call with them 2 to 3 months before your year end. This is where you can actually take action and reduce your tax bill before you get to your year end. And the second call would be a review call before filing your accounts, just to walk you through your numbers and explain what's driving your results and highlighting improvements for next year. If, by the way, you do want to work with me and my team, the link to my contact page is in the description. Now let's take a quick look at VAT and holding companies. First up, VAT. You must register when your 12-month rolling turnover exceeds £90,000. This applies to both sole traders and to limited companies. So once you get close, you need to make sure you're monitoring it, but there are some tools that are available to you to reduce the VAT you may have to pay. First of all, when you register for VAT the first time, you can actually backdate a VAT return to reclaim anything that you purchased prior to registering. That is up to 4 years for any goods you purchased that are still in your business. So if you bought a laptop 2 years ago for £1,000, you can potentially reclaim about £200 back from HMRC for that. And also for any services that you purchased in the 6 months prior to registering. I'd also be looking at which scheme is best for you. Most people just go straight for the standard scheme because they don't realize there's a flat rate VAT scheme available to them as well, potentially. And you can also look at doing annual submissions instead of quarterly submissions. Now, I'll cover these in more detail in another video, but my advice to you would be, if you're a business that is doing 6, 7, 8K revenue per month, you're getting around those sort of figures, you need to make sure at the end of each month, you are looking back at the previous 12 months and adding up your total sales figure and making sure that when you hit that £90,000 mark, you're registering straight away. Otherwise, you can get yourself into a bit of bother. Next, the holding company aspect I want to talk through. Now, these are brilliant for those of you with profitable companies who want to invest excess cash into investments such as properties or other opportunities. I won't deep dive today into this, but I will have a full video on this coming soon, so make sure you do subscribe so you don't miss that. Essentially, if you are a business owner and you are making excess cash, you don't want to pull that money out personally, but you want to build long-term wealth, you want to have flexibility about how you move money throughout your businesses, you want to be able to get access to a few more reliefs, then that's when I'd be looking into holding companies. Of course, you can reach out to me to ask me questions about that, but also have a look online, ask ChatGPT, if I can speak, for a few tips as well. So that is the whistle-stop tour of the ultimate guide to UK tax and accounting. Of course, there's a lot more details that I could go into. So if you want specialist advice or you want to book in a free consultation, the link is below, or you can DM me on Instagram at joshbuffin.myeasyaccount. If you can spare 10 seconds and you found this video useful, a like and a subscribe would be amazing too. Drop a comment, tell me what video you want to see next, and I will film the one which gets the most likes.